Good morning. Today we're going to start chapter 14, audit of the sales and collection cycle. The last four chapters that we're going to cover this quarter are chapter 14, 16, 23, and 24. Test of controls and test of transactions over the sales and collection cycle. Then we're going to audit accounts receivable, then audit cash, and finally we're going to wrap up the audit. In the sales and collection cycle, we're going to talk about sales and cash receipts. That's all we've talked about all quarter for all practical purposes. We should realize in the real world, sales returns and allowances are in the sales and collection cycle. Writing off uncollectible accounts is part of the sales and collection cycle, and bad debt expense is part of the sales and collection cycle. We're going to assume that they're not significant for our client. So we're going to focus on sales and cash receipts, but be aware that the other transactions are part of the sales and collection cycle. Here are the journal entries related to credit sales, cash receipts, sales returns, writing off accounts, and estimating bad debt expense. So those are the journal entries you learned in 321. Again, we're going to focus on the top two. If I look at T accounts, the green guys are credit sales. The red guys are cash receipts. So we're really only working on three accounts here. Chapter 14 is auditing sales. Chapter 16 is accounts receivable. Chapter 23 is cash receipts. So that's pretty much the rest of the quarter. Now, we all learned in 214, 321 that cash receipts equal sales plus or minus the change in accounts receivable. We can rearrange that, and in a simplistic sense, I know it can get more complicated than this, but in a simplistic sense, sales should equal ending accounts receivable plus cash receipts minus beginning accounts receivable. 321, you learned for revenue recognition that we need to identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price across the performance obligations, and recognize revenue as each performance obligation is satisfied. The SEC for public companies is a little different. It's pretty much the same. Delivery has occurred or services have been provided. Collectability is reasonably assured. That's what we learned in 214. We've earned it, and it's reasonably collectible. The SEC says persuasive evidence of an arrangement exists, and the seller's price is fixed. This is really fairly consistent with the FASB. Identify the contract, performance obligation is satisfied, determine the transaction price, and the accounts receivable is realizable. We will almost certainly collect the money. Make sure you know the difference between recognize and realize. Recognize means that we're going to recognize it on the financial statements. Realizable means we believe we will actually collect the cash. When we learned the 5 components of internal control, COSO's 5 components of internal control, in control activities, one of the elements of control activities were adequate documents and records. They're going to keep coming back. They relate to what we're covering now. Page 458, it's got a list of the documents and records that we use in the sales and collection cycle. The customer order, sales order, shipping documents. So I suggest that you read those and become familiar with them. I'm not going to directly test you on them, but I assume that you're familiar with these documents. You should be familiar. These are the documents you're going to audit when we audit sales and collection. In a paper-based world, there would be physical documents. In a computer-based world, they're still going to have some type of representation of these documents in the computer-based world. 315. How do I stress how important I think this is? So thou shalt know it. Is it likely to be on the final? Yes. Okay, so make sure you know it. Our documentation needs to demonstrate that we understand the accounting system. You can't audit what you don't understand. Page 345, how do we determine the risk related to all relevant assertions? So we're going to assume all assertions are relevant. That's maybe not true, but we have 6 assertions, right, for transactions. For all significant classes of transactions, we need to identify how each transaction is initiated, authorized, recorded, processed through the accounting system. Okay, so in 321, that's how to get from the general journal into the general ledger. How's it reported in the financial statements? How's it get from the general ledger to the financial statements? And the disclosures. Don't forget the disclosures. And we're going to identify points in the transaction where misstatements could occur. 315 talks about pretty much the same thing a little bit further. Now, I'm hoping that you learn what we had on that last slide, but 315 goes a little bit further. Procedures and records designed to initiate, authorize, record, process, and report transactions. Maintain accountability for assets, liability, and equity. Procedures and records. Okay. These are transactions. How do we transfer that information to the general ledger? We also need to capture information that's relevant to the financial statements, such as depreciation, amortization, changes in recoverability. For the most part, these are our adjusting journal entries. And finally, ensure that information is captured that needs to be disclosed. So a big thing is, how do we capture the information that's required for the financial statement disclosures? Okay, so I'm really worried about that top one, but make sure you realize that our accounting system has to capture, or more correctly, the client's accounting system has to capture additional information to help us with the adjusting journal entries and also capture the information necessary for disclosures. For each significant class of transactions, we must document our understanding of the accounting process from initiation of the transaction all the way into the financial statements. And we're probably going to use a flowchart to do a big part of that. I was never any good at preparing flowcharts. I think they're really good if somebody prepares one and gives it to me. I know you all had Caney, so you're good at preparing flowcharts. One up on me. But I use a flowchart to think, what could go wrong? What would happen if we received a customer order and nobody approved it? Could we sell goods for more than the customer's credit limit? We prepare a sales order, okay, and we send a copy to Harry in the shipping department and a second copy to Virgil in data processing. So what could happen if it gets lost between here and there? So I say, what would happen if we gave a copy of the sales order to Harry in shipping, but we didn't give a copy to Virgil in data processing. Would it be possible for Harry to ship goods to a customer and data processing never bill the customer? What would happen if we sent a copy of the sales order to Virgil in data processing and didn't send one to Harry in shipping? Would it be possible that data processing would bill the customer, create an invoice, and bill the customer when the customer has not received goods? So we'll probably have a control built in there that we send a copy to shipping and a second copy to data processing. But data processing is instructed to file their copy until they receive a copy of the bill of lading from shipping department. Then they match the bill of lading with a sales order, and they prepare an invoice and post it to the sales journal and the accounts receivable master file. Okay, so that's a control. Now, what can I do backwards? What would happen if Virgil just wanted to overstate sales and keyed in a sale into the sales system and created an invoice for a customer? What could we do to prevent that? Well, we're going to require that Virgil enter a sales order number and a bill of lading number that are valid. Okay, a sales order that's been used and a bill of lading that's been used. And they should be able to coordinate those. So I'm going to walk forward through the process and say what happens if somebody drops a piece of information. I'm going to walk backward. What if somebody tries to fake a sale here, a fictitious sale? What if Harry ships goods where there's no sales order? So we're going to require cross-referencing on the documents. Table 6.3, Tad's favorite. Now here you're responsible for all 6 now. My favorites are still occurrence and completeness, accuracy coming up in 3rd place. But you need to be familiar with classification, cutoff, and presentation. They're fair game on the final. 500. I hope you know it by now. It's fair game on the final. It and 315 are my favorites. You know that. For each significant class of transaction, for each management assertion for which we assess control risk is less than max, we need to identify specific control procedures. So this table, as we look across, there's my 6 assertions across the top: occurrence, completeness, accuracy, classification, cutoff, present. There they are. And let's pretend we have 5 significant classes of transactions. Now let's get real. That'd be kind of a minimum, wouldn't it? So we've got at least 5 classes of transactions, and we're going to have to preliminarily assess control risk for each assertion for every significant class of transactions. So in this case, we'd have 30 preliminary assessments of control risk. Now notice the pink and the yellow are color-coded here. Those are the only 2 we're worried about in this class: credit sales and cash receipts. Now, let's look at credit sales. For occurrence, we assess control risk as medium, completeness, low, low, low. So all these are less than the max. And the auditing standard says wherever we assess control risk as less than max, we must identify specific control activities, test those control activities, and evaluate and report the results of our tested controls. So occurrence, what's occurrence mean? The shipments, all recorded sales represent shipments to real customers. So what controls do they have in place? Well, there's an invoice, there's a bill of lading, there's a customer order. So we know the customer ordered it. How can we test that? Oh, we'll design a test to make sure that for each sale there is an invoice, bill of lading, sales term, and then we're going to evaluate the results. Completeness. What's completeness mean? That all sales, all shipments to customers, all legitimate shipments to customers were actually recorded. And we have to identify control activities, test those control activities, and evaluate and document the results of those. So the purpose of these two slides, last two slides, is just to get it through your heads. Wait a minute, this assessing control risk is low is not a simple thing. There's lots of steps involved. It's not all that easy. Tomorrow we'll go on with testing transactions, test of controls, and substantive test of transactions. Thank you and have a good day.